The minutes from the last Fed meeting pointed to more rate hikes that could go beyond market expectations. Steve Leisman joins us right now with more. And Steve, I don't know whether I believe this or not because we've seen a lot of different data since these minutes were first taken.
Yeah, Becky, overall, I think one way to think about it is equity markets like what they heard in the minutes of the Fed's May meeting. It rallied modestly after their release. You got a little more rally this morning. But it might have been a case of wishful hearing here. The minutes showed widespread committee support for 50 basis point rate hikes at the next two meetings. That was after they raised 50 at that meeting, and then moving expeditiously to neutral. But commentators seized on the possibility of a pause after the Fed gets to neutral. The minutes said, quote, many participants judged that expediting the removal of policy accommodation would leave the committee well positioned later this year to assess the effects of policy firming. That's Fed speak for, hey, maybe we're going to chill for a little bit. And yet there also seemed to be agreement on the committee for the Fed to go beyond neutral, which is usually put in the range of 2.25% to 2.5%, to a rate that acts to deliberately slow the economy. Quote, a restrictive stance of policy may well become appropriate, depending upon the evolving economic outlook and the risks to the outlook. The minutes did not provide any hint of how restrictive policy could become, only that participants see upside risk to inflation from the Ukraine war, the China lockdown, and rising wages. So the outlook for Fed rate hikes eased back somewhat in futures markets. The highest point on the curve now is May 2023. It had been in August. It's now at 286. That August contract had traded as high as 340. So almost 50 basis points has come out of the outlook for the Fed. Hard to square all this except to say the Fed may well pause to assess its progress this fall or ease back to 25 basis points hikes. But it's just as likely it keeps marching rates upward well into 2023. Becky?
So, Steve, you understand the Fed very well. You are very well connected in terms of your sources and how deeply you follow this stuff. When you're telling me that the market might have gotten it wrong, I'm interpreting that to think that, wow, maybe Fed officials were a little surprised to see the market move the direction that it has so quickly when it comes to yields, like the 10-year now back at 2.7%. Maybe they're thinking the market isn't hearing it correctly. Maybe they're interpreting it wrong, and maybe we should think that this pause or this pullback in yields is temporary.
You know, I'm right in the middle on that, on the answer to that question, Becky, because, you know, I think what we can dial in are the 50s coming in June and July. I think that seems pretty clear. You've got Bostic over here talking about the possibility of a pause, maybe some other support on the committee for that. And yet there's people like, you know, Mester and Bullard that want to see the Fed go further and possibly enact a restrictive policy. The chairman himself has said that it's possible. I think the fear here is that the market reads these minutes as an all clear. It's maybe that terminal rate that's in there, guys. If you put that chart up again, that 286 or so, which is now baked in for May of 2023, that may be too low. And I think that's perhaps a concern there. Is that, yeah, it's 286 now for May 2023. It's really interesting how that has evolved there. That number, that high point on the chart had been in August at 340. And that was just earlier this month. You were remarking, Becky, earlier in the show about how dramatically the 10-year has moved in just the past week. Well, that's reflected here. So it may be that the market might have been right at that 340 level. But we just have to see. If you get more cooperation on inflation, then the Bostic idea of a pause could be correct.